The market doesn't know what keeps you up at night. It doesn't know when you want to retire, and it doesn't know how old you are. The simple truth is, the market doesn't care. But if you care, you've tuned into the right place. You're listening to Investor Resources, bringing clarity to the confusing world of finance. Here are your hosts of Investor Resources, Don Creech and Perry Sykes.
I'm Don Creech.
And I'm Perry Sykes, and welcome to the Investor Resources Podcast.
Well, if you've ever been on a website to find out what you should do with your portfolio, looking for an investment choice to replace something, or talk to a financial advisor, or listen to Warren Buffett, well, maybe not listening to Warren Buffett, because Warren Buffett says diversification is for people who don't know what they're doing. But the odds are you have a diversified portfolio that's been structured by a certain amount of, and let's call it almost antique data and theory. You should own a bit of everything regardless of what's going on in the market. And
There you go.
that's considered to be a safer way to invest. One of the ways, or one of the implementations of that whole process, generically referred to as modern portfolio theory, is everybody should own some international stocks. Everybody should own bonds. Everybody should own a little bit of commodity. In the U.S. market, it should be broken up between various sectors or growth and value. You just pick a whole bunch of different categories and let's put them into a pile. Not, we don't call it a pile, we call it a portfolio.
There you
And
go.
then you're good to go.
And you own them all the time. You don't change that. That becomes the structure for your portfolio, and it doesn't matter what's going on in the market. That's where your money's invested.
I don't remember when this came out, but there was a popular song a number of decades ago, which if you're a boomer, you probably recognize it, by the Byrds. And the lyrics were basically, there's a time to be born, a time to die, a time to plant, a time to reap, time to kill, a time to heal, a time to laugh, a time to weep. To everything there is a season and a time to every purpose under heaven. We believe that's appropriate for your investment portfolio. Owning international securities just because they're international is a pretty poor reason for putting something into your portfolio that may lose money for a decade or more. It's kind of like owning gold in 2011 when we were on the radio at the time and said, hey, it's time to get out of gold. And it wasn't until this year that gold actually broke the 2011 high. So you're 13 years waiting for that money to actually generate something for you. Most of the time you would not make that decision intentionally. So you
never would. You know, Don, especially in your real life, just in your day-to-day life, would you ever walk out of the house every day wearing a raincoat, no matter what? Middle of summer, 75 degrees, clear blue sky, but I'm wearing a raincoat because sometime, eventually, it's going to rain. And by good golly, I'm going to be ready when it does. No, you would never do that. You put the raincoat on when it's raining, when it's necessary, when it's going to add value to you to leave the house. Not every day, not all year long. Nothing else in your life works that way. And your portfolio shouldn't either. It's very easy for whoever's managing your money to say, well, no, let's just own a little bit of everything all the time, because that simplifies my life. It doesn't do much for your portfolio, though. And it's just as silly to have something in your portfolio all the time just because as it is to be wearing a raincoat on a sunny day.
Commodities work much the same way. They're in and out of favor. They're more volatile typically than the international stocks. But that's one of the main assumptions about running a portfolio properly and what is considered risk management, because foreign securities can be uncorrelated, if you will, from U.S. market. If you have all your money in the U.S. market, you're missing out on opportunities. Well, you're not always missing out on opportunities. Sometimes you're missing out on disaster happening to your portfolio, and it's being masked by the things that are working. So if it's really unwinding, why not take it out of the portfolio until conditions improve? With regard to your raincoat, you take it off when it quits raining and the season change. And it comes back
Bingo.
out of the closet in the fall when the season is returning to high probability of bad weather. The stock market, the equity market, the bond market, the commodities market, the currency market all have seasons to them. And your portfolio, we believe, should adjust to those seasons. One of the things that we do for our 401k corporate clients, and of course their employee participants, is review this data consistently. And everybody can do what they want to do with it, but we review the data, make it available, and then run models that are based on what's working. If it's not working, we don't want it in the model.
Mhm.
The problem with that is somebody has to pay attention. And for the most part, employees don't have time to pay attention. They're being paid to do other tasks that help the employer and keep them employed. Their home life, most of them don't spend a lot of time paying attention to the markets. But this rotation goes on all the time. Sometimes it actually surprises people. Let me share a screen with.
Surprises us. we, it surprises anybody who's paying attention because you really don't ever know what's going to pop up, but it does. Things pop up and you need to be paying attention to it.
So what we're going to look at is a list of the funds that we use in our 401k corporate plans. This particular screen is from September of 2021. And just a brief explanation of what we're doing here, what we're looking at. This number one position, First Trust Enhanced Short Maturity, is an exchange traded fund that invests in short-term corporate paper that matures on average every 30 days. So you're not taking a big risk of a company going bankrupt, because if they were that close, they wouldn't be able to borrow money for even for 30 days typically. This is high quality paper, and it's our equivalent that we use for risk management. We want to own assets in the portfolio that are doing better than cash. If you intentionally put positions in your portfolio that were losing money, what would your spouse say? Hey, honey, I just bought this asset in our portfolio and I think it's going to go bankrupt. Well, maybe not that bad, but we're going to lose money on it. What do you think? That's probably not going to be good dinner conversation.
Time to stand
But
back. Yeah. So,
so the point here is that at the top of the list, the assets that are doing well, this is September of 21, were bonds, bonds, bonds. Here's a conservative modern portfolio theory, retirement account. And then we get into some commodities that were doing well. There's gold. As we get down the list, the returns get worse. So let's just move forward a year. Well, actually 2 years. This is September 29 of 23. And here we are with our cash bogey close to the top and short-term government securities at the top. We scroll down a bit, we have more bonds. There's some gold and silver, and here's some international down at 14. That's slipping. What we look at right now, or recently, this is September of this year, and our cash benchmark is all the way down to the bottom of the
bottom.
list.
Yeah.
So everything that you can pick on this list of 34 other choices is doing better than cash. So if you're not certain what you're going to buy, you can kind of throw the dart at this list and say, right now it's working out okay. Now, where we started out was international funds. Should you own international funds? And those two snapshots of September 1 year and 3 years ago, it didn't make any sense even to be in the market, much less international. But right now, international happens to be a strong performing asset recently. And if we just look at the top of the list, let me expand this just a little bit. Here we are with emerging markets, right in the number one position, followed by gold. We have some real estate. There's gold and silver again. Got some mid cap. Then we have some more aggressive target date funds, which are by definition, they're designed for younger people who have more time to go before they retire. But our managed portfolios, we go back up here to the top of the list, and what we see is our allocations heavily weight international. We have international small cap, international, this is the EFA index, which is Europe, Asia, and the Far East. We have Schwab International, which is mostly developed countries, so not very much emerging market. Another developed market international exposure, then gold, gold and silver, and real estate. So here we are with 40% exposure into various aspects of the international market because the time is right. Just as is the lyrics or the chorus in the Birds song, to everything there is a season. And this is a season where some international exposure makes sense. It's not arbitrary. It's driven by what's actually happening in the market. It's not driven by your opinion of how you feel about international stocks.
Correct. Or a long-term average that says, well, over the last 75 years, here's where international has fallen. So you should have 8% of your portfolio in international all the time. Doesn't make any sense. Sometimes you should have a large position. Sometimes you should have none. And that's the way our portfolio process works. That's the way every asset class is reviewed. How is it doing right now? How is it doing right now? That's all that matters. The historical averages don't matter. If 5 years ago it was the best place on the planet to be, doesn't matter. It's not, it's all about where are things today, and that's what makes the difference. If you're going to be paying attention, you can buy the things that are doing the best, and more importantly, you can stay away from the things that are doing very, very poorly. You can see them; they're not attracting any money. No one's investing cash there. Share values are dropping. Don't buy them right now. Stay away from that. It really is that simple. Look at what's making money and own it. Look at what's not making money and avoid it. And that's the process we follow.
Well, that gives you priority over things that are actually working, and it gives you an opportunity to pay attention to what's going on in the market and it requires that you have a strategy and you have some rules. A
Sure.
lot of people don't want to take the time. They feel I'm not qualified to do that. I talked with a lady who in tech support, we were talking about markets, and she said, I just do not feel comfortable having my money in the stock market because I do not know what I'm doing. Well, that's a sensible person. If you don't know
Right.
what you're doing, you need to get some help. You can spend some time learning. That's typically, even with the software package, it may take a couple of years to get comfortable in learning which rules work for you and which ones. As she said, I just can't go to sleep at night knowing that I'm losing money.
That makes it not worth it. Yeah. If you can't sleep at night, you're investing for your future well-being, right? And if it becomes a big enough distraction that it's actually taking the joy out of your being alive, that's no good. You need to find a different way to work it.
So a couple of months ago, a lady asked me what I did, and so I explained briefly. And she said, "Well, I have an advisor, and that's what he does. And I call him every now and then, tell him what I want to do." I said, "Well, he doesn't do what we do because you're
Right. That's
telling
not
the
the same.
advisor what to do. You have to
Yep.
replace financial advisor with financial salesperson or broker because that's what the majority of them are. An
Yeah.
advisor does not collect commissions and acts as a fiduciary all of the time, not just when it is going to be acceptable for the moment, when he's challenged about what's going on here. And how do you do that? Well, you have to remember that the investment arena is designed and exists to raise money for corporate America. That's why
That's it.
stockbrokers exist. Brokerage firms are the way that we raise money to fund ideas. That's how Elon Musk got his start to build his companies. You take any company that got started and is traded on the exchange at some point in time, they ask for help raising capital to expand their business. And that's the
Yep.
stockbroker's business. But being a broker is no longer a highly valued um, brand name for what your job classification is. So it's morphed into financial advisor. We don't sell anything, we give advice. We help you achieve your goals. But it's still a process of raising capital. The only way around that is for you to find somebody who is a fiduciary in every transaction they do for you, where they are making decisions on your behalf rather than you giving instructions saying, well, this is what I want. You can do that, but that means you're in charge and you're responsible. The broker's facilitating what you want to do rather than saying, this is the time to be buying this asset class because we haven't had it and it's turning around and getting better. That's our point in dealing with international stocks today. There's a time to be in the portfolio. There's a time when the season turns and it doesn't need to be in your portfolio. In fact, it shouldn't be in your portfolio. So
Correct.
unless you're making that decision yourself, which you probably are by filling out a risk questionnaire, you need somebody who's going to take charge and say, no, I know you're uncomfortable buying Japan, but Japan's a bargain and it's getting better. It needs to be in your portfolio.
Correct. And that's what we do. And we don't mind being in charge of what goes in and out of your portfolio. It's what we do. That's one of the big differences between having a fiduciary manager money and having somebody who's taking an order taker in essence. We're going to let you know why we're doing things and why we think it would be in your best interest at any point to be invested in the things that we own. And we should probably look at wrapping that up for today, Don.
Okay, so at the bottom of the screen down there is the subscribe button. Go ahead and subscribe. You get notified of the next update. And on our website, you can register for the next webinar, which we do on the first Saturday of the month at 9 a.m. Pacific. If you want to talk to us, give us a phone call or send us an email. Have a great day, and we'll talk with you again.